All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world, and happy Wednesday, everybody. Today is August 20th, 2025. And our top story this morning is the consumer and the housing market. In other words, that major, huge chunk of the economy that has nothing to do with AI-generated slop and data centers. And, well, that whole portion of the economy really sucks, even as the AI and the data center portion of the economy is currently undergoing some kind of a sectoral rotation. We had a big sell-off in big tech yesterday. People were rotating out of those high-growth tech names and into safer perceived value plays in the Dow. Maybe that's got something to do with Sam Altman confirming what I've been saying for years, that AI is in a bubble, or maybe it's just a minor blip on our road onward and upward to new absurd all-time highs. But meanwhile, the rest of the economy is in a slump. Look no further than Target earnings and Lowe's earnings that came out this morning. Now, both companies beat earnings and beat revenue. Oh, it was a beat on the top and bottom line. And that's like that kid that knocks down one pin, even though the bumpers are up, and the parents are like, oh, Timmy, you did such a great job bowling, even though a blind idiot with one arm could have bowled better than that. That's CNBC right now talking about the beat on the top and bottom line for Target and Lowe's. But beneath this lowered expectations that have been miraculously overcome, what do you actually have here? You've got Target earnings, net income was down 21.5% year over year. Yikes. Now, I'm sure some of you guys are going to talk in the comments about how this is still blowback over that thing with the bathing suits from a few years ago. Maybe there's still some of that lingering, but I don't think that is responsible, because we're more than a year removed from that story now. It's been well over a year. So that decline should have already dropped off. This 21% year over year decline is something more than that. This is consumers are just broke. People have no freaking money left over. 90% of the country has been in a deep, severe recession since the middle of 2022. And then the 10% that's doing really well is like, what's the matter with you other 9 out of 10 guys? How come you can't see how rich I am, and therefore we're all doing great? That's kind of the mentality that is prevailing in the financial press. We also got comparable sales at Target down 1.9% from a year ago. And remember, that's a nominal figure, so that doesn't even factor in the relatively, about 3% inflation that we've got right now. Is that what the latest CPI number was? So Target's just not doing well here. They've also they named their new CEO today. Their CFO is stepping into the role. That was a planned transition. So it's not like the CEO is abruptly resigning or anything like that. But Target has had a rough year. The stock is down big pre-market this morning. It's already down high double digits year to date. So things getting worse for Target. Now over at Lowe's, things are slightly better than that, but not by much. I would say Lowe's did a little bit better than Home Depot, but again, we're just beating lowered expectations. The comps at Lowe's were positive, 1.1% year over year. But again, that's not adjusted for inflation. When you've got 3% inflation and 1% growth, that means you're actually shrinking by about 2% in real terms. And so Lowe's is struggling with that as well. There's also the announcement they're buying foundation building materials. That's a wholesaler for things like drywall, insulation, interior goods. So Lowe's is going after the contractor business, right? That's always been the big difference between Home Depot and Lowe's. Lowe's is always geared more towards consumers, end users, whereas Home Depot has kind of always been more geared towards the contractors. Lowe's is going after that contractor business of Home Depot. It's an $8.8 billion merger for foundation building materials. Also, we've got stagnant numbers, beneath the surface. They raised their guidance a little bit towards the upper end of their guidance, but at the end of the day, you've got numbers that are changing very little year over year. You've got stagnation in the housing market. The housing market is frozen from the combination of golden handcuffs, people who refinanced at nothing% interest rates during the pandemic. They're not giving up that house with that low mortgage, not to move into something smaller with a double the interest rate. And you got higher interest rates. You've also got obscenely high home prices are contributing to this frozen housing market. So you got consumers struggling. You got housing frozen. Another interesting story today, McDonald's is cutting their prices on value meals. They're cutting them further. They're doubling down on gaining market share via affordability. We've seen McDonald's has been very successful in doing this in the last year or so, ever since they bought back the $5 value meal. That was wildly successful in bringing customers back to their restaurants. So they are going even further here. They cut a deal with their franchisees that even includes financial support if necessary to get those prices lower. It's almost like the solution to higher prices is, no, it's not price controls. No, it's not tariffs. No, it's not higher taxes. No, the solution to higher prices is higher prices. Just take your hands off the panel. Let the ship right itself. McDonald's doing the right thing here. Will it be successful, or will it be more successful in bringing people back in? Only time will tell. But again, the restaurant business for the last couple of years, it's been a really rough business to be in. McDonald's has done okay by cutting prices, hoping to build on that success here. Another interesting story, Japan's exports way down more than expected, 2.6% lower year over year for exports that's out of Japan. And the market was expecting a 2.1% decline, dropped by more than that, 2.6%, quite a bit more than that. Look, we all know what this is. This is the trade war. Case in point, U.S. exports down 10.1%. That is Japanese goods shipped to the United States down 10% year over year. In particular, vehicles, auto parts, and steel are taking the hit there. That is President Trump's tariffs taking a big bite out of Japanese business. And if they're not careful, that could knock Japan further into recession. And keep in mind, Japan's trying to raise interest rates. They're trying to get out of this ridiculous cycle of modern monetary theory that they've been struggling with for the last 10 years, that just basically saw the Japanese central bank become the market for long-term Japanese government bonds. They're pretty much the only player in the space now. And so with Japan's exports taking a hit, that could complicate Japan's efforts to normalize monetary policy. Also going on overseas, we've got the United Kingdom, UK inflation rate, 3.8% year over year, higher than expected and up from 3.6% in June. Inflation is going the wrong way in the UK. And this is after their fifth rate cut recently. The UK keeps cutting interest rates and inflation keeps going higher. Gee, I'm beginning to suspect that these two things might be related. Pay attention, Donald Trump. Pay attention, Federal Reserve. We're over here in the U.S. and the market is like screaming, give me rate cuts, even though stocks and everything are at all-time highs. Give me more. Well, they gave them more over in Europe. The economy didn't get any better. Inflation just got worse. Employment continues to get worse and just making everything worse. The easy money is the problem. Have we realized that yet? No? Okay, go ahead. Keep cutting rates, keep printing money, and just hope things work out differently this time. By the way, the UK Central Bank, the Bank of England, they have said that inflation is expected to rise to 4% next year. In other words, it's going to keep getting worse. Oh, that's nice. If you're already struggling with what inflation has already done to your family finances, don't worry, it's going to get even better. But then the BOE says magically inflation will come down to 2%. After that, kind of like they told us it would be transitory back in 2021. Remember, they told us, don't worry, inflation might have to rise a little bit higher than our 2% goal. But don't worry, then it's going to come right back down. It's only going to be temporary. How's that going for you guys? Keep up the bad work. We've also got totally unrelated news. Airbus workers in the United Kingdom are going on strike. You think maybe that has something to do with the rising cost of living? I don't know. Maybe I just make these random connections in my head. Who knows? But look, last year it was Boeing. This time it's Airbus. It's their turn. Workers halting work, not working over in the UK. It's pretty much what it comes down to. And Labubu is back in the news. Oh my God, I hate this story. When I say I hate the story, I mean I love this story because it's so freaking ridiculous. I just love to talk about it. Labubu has driven Pop Mart. Let's see, what do we got? Pop Mart stock was higher by 12.5% the last time I looked, on a 400% increase year over year in profits over at Pop Mart. Why? Because grown-ass men are putting little doll keychains on their clothes and their man purses. Okay. We're going to put a pin in that one. We're going to come back. But guys, we need to talk. All right? Really, please sit down. We're all here to talk because we love you. But somebody needs to explain this shit to me. Sorry. Last but not least, don't eat the shrimp at Walmart. It's radioactive. Oh, that's fun. Who had that on their, who had cesium-137 in their Walmart shrimp for their 2020s bingo card? God, I freaking love this job. Why don't we shrink my big melon of a head and let's see what's going on in the world of finance today. Hey, don't forget that like button and that subscribe button for you new guys so you can come back tomorrow and have your coffee with the melon heads as we go through markets every single day. And right now, the S&P 500 is down a modest 6 points, 0.1% lower. I believe that is the big tech names are holding down the S&P again this morning after a big sell-off yesterday in big tech. The Dow is higher by a measly 4.5 points here, a slight rotation into your value names in the Dow. And the NASDAQ is leading the way lower again today, off by 56 points or about 0.25%. So we're still seeing that rotation out of growth and into value. That is something of a risk off emphasis, something of a risk off. We're not exactly seeing like big demand for gold or treasuries or anything here. Meanwhile, the dollar's a little bit weaker. Again, 11 basis points to the downside, 98.17 for the Dixie. And looking over at the bond market, we've got mostly red and a little bit of green there in the 30-year treasury. The 30-year yield is at 4.905. That's higher by a fraction of a point. Pretty much everything else is red. The 10-year is at 4.298. That's off by about 0.5 point. The 2-year, 3.744. That's 1 point lower. And the 1 month is off by a fraction of a point at 4.340. Looking over at the commodities board, all right, there is a little bit of safe haven demand this morning. How about that? That must have popped up in the last few minutes here. Gold is higher by $27.31. Spot gold is at $33.43. That's about 0.8% higher. Spot silver, meanwhile, is at $37.67. That's higher by 28 cents or 0.75%. I like the shiny. Copper, meanwhile, is up by 0.2%. Platinum, 2.25% higher. Palladium higher by 1.5%. And crude oil is higher by 1.25%. So commodities, a whole bunch of green today, 62.53 for October WTI futures. Now, one commodity that is not in the green, at least not versus yesterday, is Bitcoin, $113,267 as priced on Coinbase. Now, that's showing we're higher by about $400, but that's off of the lows that we had yesterday. Yesterday, we went as low as 112,696. So part of this little bit emphasis, a little bit of risk off that we're seeing in big tech names and the sell-off in some of your AI names. We're also seeing that in Bitcoin. That all coincided. It all traces its roots back to that PPE reading that we got last week, that higher than expected PPE read. That was the top for Bitcoin. Ever since then, a few hours later, we got news from Besant that the U.S. government wasn't going to be buying Bitcoin. No big surprise for me there. But Bitcoin started selling off on that news, and it pretty much hasn't slowed ever since. Also important, yesterday, we lost the 50-day moving average. We haven't done that since June for Bitcoin. So watch that level. 50-day moving average is right around 116,000. All right, let's talk about the main story today. Target shares tumble as retailer picks new CEO and says sales fell again. The consumer continues to struggle with the higher cost of living and a lack of any real wage growth. Target beat Wall Street's earnings and sales expectations and reaffirmed its outlook on Wednesday, even as the discounter's sales and traffic across its stores and website declined. Again, beating expectations here. When you lower expectations this much, you shouldn't go around bragging about beating them. That's just doesn't work that way. Yet the Minneapolis-based retailer pointed toward the future and its focus on getting back to growth by naming its next CEO, Chief Operating Officer Mike Fidelki. Did I say that right? Mike F., who has also served as Target's CFO, will step into the role on February 1st. He will succeed CEO Brian Cornell, who will become executive chair of Target's board of directors. Fidelki is a 20-year Target veteran. Again, that CEO transition was previously planned. The name of the new guy, that's news today, but we've known Brian Cornell was going to step down for a while here. So it's not like this is a panic CEO change or anything. Let's see what we got by the numbers here. Earnings per share, $2.05 versus $2.03 expected. Revenue, $25.21 billion versus $24.93 expected. Okay, so yeah, beat on the top and bottom line, but let's look at some of these other numbers here. Target's latest quarter reflected its ongoing struggles. Its net income fell to $935 million or $2.05 a share. That's down from a $1.19 billion or $2.57 a share in the year ago quarter. That is a 21.5% year over year decline in net income. Yikes. That is brutal for Target. Revenue declined from $25.45 billion. What was the original revenue again? Okay, it was $25.21. So a smaller decline in revenue, but a big hit to profit margins here. Comparable sales decreased by 1.9% year over year. That is a terrible number. Again, you got to add 3% inflation to that. So realistically, you're looking at almost a 5% decline in the amount of goods being sold at Target here. That metric, also known as same-store sales, includes sales on its website and stores open at least 13 months. Customer transactions dropped 1.3%, and the average amount customers spent during those transactions also declined 0.6% from the year-ago quarter. Guys, these were really, really bad numbers from Target here. But again, all you get, they get headlines, oh, it beat earnings, it beat expectations. But you got to realize the expectations suck. And that's why the stock is down 10.3% ahead of the opening bell here. Brutal morning for Target, $94.48 a share, off by $10.90. And that's after the stock has already fallen 22% year to date. So Target well off its highs here. The consumer continues to struggle. Now, that being said, guys, I got to mention here, Target's price PE multiple here, again, earnings is falling pretty rapidly here, 21% decline in growth, but it's trading at an 11.5 PE. Target shares are starting to look pretty cheap here. Forward dividend at 4.25%. I don't know what the payout ratio is. Let's see. What are they paying out right now? At 4.25%. Dividends, your payout ratio, 49%. Okay. That's a little bit higher, especially with a 21% decline in their net income. So maybe that dividend might be at risk here, but it's worth keeping an eye on this name. This one's pretty beaten down. All right. Lowe's a little bit better, but not by much. Lowe's beats on quarterly earnings and buys Home Pro's business for $8.8 billion. They're going after Home Depot's contractor business. Lowe's beat Wall Street earnings expectations on Wednesday as demand for home projects picked up during the quarter. The retailer also announced its latest effort to attract more business from home professionals. It said on Wednesday that it has struck a deal to acquire Foundation Building Materials. That's a distributor of drywall, insulation, and other interior building products for large residential and commercial professionals for $8.8 billion. They also revised their full-year outlook to reflect the acquisition of Artisan Design Group. That's a home professional focused company that they acquired earlier this year. It said in a news release that its core business performance in fiscal 2025 remains unchanged. For the full year, Lowe's said it expects total sales of $84.5 billion to $85.5 billion. That's a slight increase from its previous range of $83.5 to $84.5. It reiterated its comparable sales, a metric that takes out one-time factors like openings and closings, saying that they will be flat to up 1% from a prior year. All right, so a little bit, excuse me. Still fighting that sore throat. Look, we got a little bit of a raise in their forecast here, but those comps numbers that they're forecasting here, flat to up 1%. Again, when you factor in inflation, that's showing a decline. So not great numbers there. They expect earnings per share of $12.10 to $12.35. That's down slightly from their prior range of $12.15 to $12.40. So again, their bottom line not looking any better here. Let's see. Earnings per share, $4.33 versus $4.24 expected. Revenue, $23.96 versus $23.96 expected. That's right in line. Home improvement demand has been weaker as high borrowing costs and mortgage rates keep some homeowners and potential homebuyers on the sidelines. Yeah, some, pretty much all of them if we're talking about younger generations. To overcome those slower sales, Lowe's has looked to home professionals, a steadier and more lucrative customer, to drive sales. All right, so Lowe's looked a little better than Target, not a whole lot better. Let's see what the stock is doing. Up 3% ahead of the opening bell, $264.25. That's up by about $7, almost $8. Year to date, Lowe's is flat. It's up about 3% year to date. So you can add another 3% to that with the pre-market move. So Lowe's, they're looking a little bit better here, but not by a whole lot. And you know, another interesting thing, guys, neither Lowe's nor Target, those two articles, very little mention, if any, of tariffs or the trade war. That seems to have fallen out of the headlines. We've got a little bit more certainty on tariffs. Neither company is really warning about any kind of tariff impact here. That's interesting. Put a pin in tariffs. We'll be back. Meanwhile, McDonald's to cut combo meal prices after convincing franchisees. The solution to higher prices is higher prices. McDonald's is lowering the cost of its combo meals after consumers were left sticker shocked by Big Mac meals that climbed to $18 in some places. The Burger Giant's move follows weeks of discussion between McDonald's and restaurant operators, including the company offering financial support if franchisees agreed to drop prices, according to people involved in the discussions. After pitching operators on the plan, McDonald's and its U.S. franchisees agreed to keep the cost of 8 popular combo meals 15% below the sum of the individual items' prices. That's according to company materials viewed by the Wall Street Journal. The chain will also run $5 breakfast and $8 Big Mac and McNugget combo meals. That is combo meal specials later this year, marketing them as extra value meals. So that $5 breakfast, that's a new one. The move is part of the chain's push to restore its reputation for affordability, which has taken a hit with cash-strapped consumers. McDonald's has said that its new McValue deal menu is helping, but many consumers still feel the chain's menu prices overall are too high. So we got that one in the Wall Street Journal this morning. What I didn't have ready is a McDonald's stock quote. Let's see what the stock is reacting to this. All right, up a little bit on this news, 0.85% higher, $313.31 for McDonald's. That's up by about $2.60, and McDonald's shares are already up about 7.25% year to date. All right, now I told you to put a pin in tariffs because tariffs, maybe they're not affecting Target, they're not affecting Lowe's, but they're definitely affecting the Japanese this morning. Japan's exports fall the most in 4 years as tariff pain deepens. Japan's exports sustained their deepest drop in more than 4 years as U.S. tariffs continue to weigh on global commerce, clouding the outlook for economic growth at a time when personal spending remains unsteady. Exports fell 2.6% in value in July from a year earlier, sliding more than the median forecast of a 2.1% decline, the Ministry of Finance reported on Wednesday. The downturn, led by cars, auto parts, and steel, was the biggest since February of 2021. And guys, cars, auto parts, steel, that is those sector-specific tariffs that President Trump put on those. They are taking a big chunk out of the Japanese here. Export volumes rose by 1.2%, suggesting exporters are continuing to absorb U.S. tariff costs by cutting selling prices to preserve market share. That is interesting. There's been a lot of talk, especially after those PPE numbers last week, about specifically what is in store for consumers. And when we saw that higher PPE, a lot of people got really worried about CPI. I'm sorry, I said PPE, PPI. When producer prices rose more than expected last week, everybody said it's just a matter of time before CPI starts going higher. And there's almost certainly some truth to that. I think we are going to see higher CPI in the short term. That being said, the Japanese are not raising their prices. Other people might be, but the Japanese companies, they are eating the cost of the tariffs here. So how much is going to be eaten by the producer? How much is going to be eaten by the consumer? That is the question that's going to be nagging at the Federal Reserve. That's the question that's going to be coming up at Jackson Hole, at the FOMC, at everything between now and whenever the rate cuts finally start. Let's see what else we got. Imports decreased 7.5% as inbound shipments of crude oil, coal, and liquefied natural gas all shrank by double digits, but the trade balance still flipped to a deficit of 117.5 billion yen. So the whole economy in Japan appears to be taking a hit here. Car shipments to the U.S. have started to decline in volume, suggesting that the impact of tariffs is finally starting to show, said Taro Saito, head of economic research at NLI Research Institute. In the U.S., prices of Japanese exports began rising around June or July, so we're now seeing these effects on Japanese goods gradually losing their price competitiveness. The report showed that exports to the U.S. dropped by 10.1% last month from a year earlier, with the value of shipments of vehicles and auto parts plunging 28.4% and 17.4% respectively. In terms of volume, exports of vehicles to the U.S. fell by 3.2%, a clear indication that car makers are absorbing a portion of the tariffs to support sales. And again, how much of a portion? That's the big question here. What is the end result for the consumer going to be? We just don't know yet. In April, the U.S. imposed a 25% tariff on imports of Japanese cars and auto parts and a 10% duty on most other goods. A levy on imports of steel was doubled to 50%. in early June. So we've got the Japanese taking a hit to their exports. Meanwhile, we've got inflation rising in the UK. UK inflation gains pace, likely keeping the Bank of England from fresh rate cuts. This one just hit the tape this morning. Annual inflation rose to an 18-month high in the UK last month, raising the chance that Bank of England policymakers might hold off from cutting rates in the coming months. Consumer prices were 3.8% higher in July than the same month from a year earlier. That's up from 3.6% in June, the Office of National Statistics said on Wednesday. That increase was higher than the 3.7% forecast from a consensus of economists polled by the Wall Street Journal. The BOE cut its benchmark rate by a quarter point to 4% at the most recent meeting. That's their fifth rate cut in a row, by the way. But the closer than expected 5-4 vote highlighted the contrasting concerns as inflation stays well above the target, but the job market and economy cools. Well, that sounds a little bit like stagflation there, doesn't it? Inflation is likely to rise to 4% in the next few months and fall back to the bank's 2% target in 2027, the BOE said. And I look at that and I just say, how? How in the freaking world are you going to sit there with a straight face, you academic a-holes, and sit there and tell me that inflation is going to be 2% in 2027? You told us that same garbage in 2021. You were more wrong than, I don't know, the weatherman ever. You were really freaking wrong about that. And they're like, don't worry, guys. Inflation still hasn't come back to 2%. Actually, it's 3.8%. We're probably going to see 4% before we get any lower. But don't worry, 2% in 2027. You'll just have to trust me. Okay, guess we don't have any choice since we don't elect central bankers and they just pretty much yield unlimited power with no consequence. There's just not enough gold, guys. There's just not enough gold in the world for what's coming. Policymakers there paid particular attention to rising food inflation, which climbed to 4.9% in July from 4.5% in June. Okay, so it's getting more expensive to eat. At least that doesn't affect poor people disproportionately, right? Keep up the good work, Bank of England. Sorry, by the way, check out the new rant emoji for anybody who's wondering. I'm sure M&J was talking about that one this morning in the chat. I haven't seen it yet, but let me see your rant emojis, guys. All right, in totally unrelated news, Airbus workers to strike at UK wing factories over pay. All right, Airbus workers are going on strike. You guys think this might have something to do with the rising cost of inflation? Maybe, just maybe a little bit. Thousands of Airbus workers in the UK are set to walk off the job for 10 days in September after 90% of union members voted to strike over the aircraft manufacturer's pay offer. Last year, it was Boeing. This time, it's Airbus. And by the way, what's the whole 10 days? Like, since when do we telegraph the end of a strike? Is that supposed to make the strike more effective? Okay, all we got to do is nothing for 10 days and they'll go back to work. That's not how you get a raise. You go on strike and you don't tell them when you're planning on going back to work. If ever, you say, I'm going to ruin your business. I'll never go back to work if you don't pay me what I want. That's just how I would do things if I was in charge. But you know what? I'm not in charge of organized labor, probably for good reason. The industrial action will start on September 2nd and continue over a 3-week period at Airbus wing factories in Broughton and Filton, according to Unite, a union that represents more than 3,000 Airbus engineers and aircraft fitters. Both sites could temporarily close down because of how many union members are based there. Wings for the A320, A330, and A350 jets are produced at the factories, representing a critical part of Airbus's supply chain. Are wings important parts for airplanes? I don't know. Could we, I don't know, maybe we'll just have planes without wings? It's just an idea. I just throw them out there. Do what you want with them. Airbus is under pressure to ramp up deliveries after a flurry of big orders for narrow body and wide body jets. Now, guys, this is kind of interesting. I'm not really sure this strike is really going to be that big a deal, especially if they're like, it's only 10 days and then we're going back to work. But Airbus is expected to be one of the big beneficiaries of this anti-American sentiment. If you want to hit back at the United States because of their tariffs, well, not buying Boeing jets is an easy way to take a chunk out of U.S. GDP. If you're not going to buy Boeing jets, Airbus is the obvious next choice. Well, if Airbus goes on strike and they can't meet their delivery schedule, that could complicate things. So this story is worth keeping an eye on. For now, a 10-day strike, probably not the end of the world for Airbus, but it's worth watching. All right, fellas, we got to talk about this one. All right, guys, you got some explaining to do. Mart shares reverse course to rise 10% after the Labubu maker posts a near 400% profit surge. Remember all that talk, all that stuff about how the consumer has no money and everybody's broke. All right, that is obviously going on. There's data to support that. But how do you jive that with a 400% profit surge in Labubu? Here we go. Shares in Chinese toy maker Pop Mart reversed course to rise on Wednesday, a day after the company posted a near 400% surge in net profit, driven by booming global demand for its Labubu dolls. Pop Mart was trading 10% higher as of 1:52 p.m. local time after dropping as much as 4.7% at the start of the session. The company's revenue jumped 204% year over year to 13.88 billion yuan. That's almost $2 billion. And its net profit attributable to shareholders soared by 396% to 4.57 billion yuan for the first 6 months of 2025, compared with last month's forecast of at least 200% growth and a 350% rise in profit. Beijing headquartered firm Labubu's plushies, a sharp-toothed, big-eared, ugly, cute dolls, some might say demonic, have taken the world by storm with its $30 keychains. They're actually $80, spotted on the bags of Rihanna and K-pop band Blackpink's Lisa. Look, guys, it's not just girls wearing these things. Like, here it is. This is the Labubu dolls. All right, this is what is driving a 400% increase in profitability at Pop Mart. And you may notice that this is a grown-ass man wearing this thing, wearing a doll keychain on his clothes because it's very fashionable. And if you search images of Labubu on Google Images, you're going to find pictures of guys with man purses with these things dangling off of them. And look, all I'm saying, girls, if you're watching, if you ever bring this home, you're out of the will. That's all I can tell you. Don't bring this home. And I'm not talking about the doll. I'm talking about the guy. If you bring home a guy with one of these things dangling from his man purse, he ain't even getting in the front door. All right. As a general rule, if you can't start my lawnmower, you can't date my daughters. And if you're wearing this thing on your satchel, you probably can't start my lawnmower. Pop Mart shares are up 12.5%. These are their shares as denoted in Hong Kong dollars, $316, up 35.2 Hong Kong dollars, 12.5% higher. And guys, the market cap on this company, $419 billion bucks. Look at this, up 655% year to date, over 5 years, up 300%. This thing is now worth more than Hasbro and Mattel combined. This is Beanie Babies, guys. It's a fad. It's obviously not going to last. The question is, how much higher can it go before it inevitably pops? I don't know. By the way, Pop Mart, this is the same company that made those stupid Care Bear things. Do you guys remember the Singapore money laundering bust from 2023? And they found hundreds of thousands of dollars of these stupid little Care Bear things. Yeah, same company. Pop Mart makes those too. All right, last but not least, do not eat the shrimp, at least not the shrimp from Walmart. Walmart shrimp may have been exposed to radioactive material, according to the FDA. This was a fun 2020s bingo update, which is why I'm including it. The Food and Drug Administration said Tuesday that the public should avoid eating certain frozen shrimp sold at Walmart due to concerns that the seafood may be contaminated with radioactive material. Health officials said in a news release that it is investigating reports of cesium-137 contamination in shipping containers and frozen shrimp products processed by Indonesian company PT Bahari Makmur Sejati of Indonesia, Gesundheit, also known as BMS Foods. Maybe we just lead with BMS Foods next time. Spare me the non-regional diction, please. BMS Foods, for the love of God. All right, guys. Look, cesium-137, that is some nasty, nasty stuff. All right. The only way to get cesium-137 is from nuclear fission. And you might be saying to yourself, how the hell does cesium-137 get into containers of shrimp? Well, actually, that's on purpose. It's not on purpose, but there's a reason for it. We use cesium-137 for food irradiation. It's a preservative. When it rolls off the assembly line, they blast it with radiation to kill any bacteria or viruses that might be lingering on the food. It's supposed to be safe. It typically is safe. It has no net effect on the food itself. That is, as long as the machine that's doing it doesn't break open and spill its source material into the food, which is where I suspect this cesium happened, unless Vladimir Putin is like making shrimp cocktails for everybody. My guess is this was food irradiation gone wrong because of lax standards somewhere in India. But keep an eye on that, guys. If you have any of that great value frozen shrimp in your freezer, probably best to throw it out. Cesium is some really nasty stuff. Don't want to get that in you. And I just want to say thank you very much to the pasta. Excuse me again. He says, are you following Right to Repair automotive software lockouts? Volkswagen has subscriptions for increased horsepower, BMW Auto High Beam for €4 a month. Look, the whole Right to Repair thing, I side with consumers on that. If you buy something, you should be able to fix it. All right, that's BS. John Deere has been struggling with this as well. John Deere faced a lot of backlash from their customers over Right to Repair. From what I understand, those court cases are still being dragged out. Enough of this. Enough of this cheap Chinese crap that doesn't last for a year. And enough of this, no, you're not allowed to repair our stuff. You got to buy a replacement plan at Walmart at checkout, or you have to pay us a subscription in order to repair our crap that is built intentionally not to last. So no, I'm not following this particular story, Pasta Man. But as a guy who's something of a DIY, which means, usually I try to fix something first myself and then I make it worse. And it's more expensive for me to have somebody else come in and fix it after I mess it up further. But generally, I am in favor of Right to Repair. So I'm going to fall on that side pretty much every time. Thank you, Pasta Man, for supporting the channel, sir. And thank you, Robert Feeds the Machine, says inflation will be 2% when Optimus is profitable, which by my calculations is freaking never, man. I shouldn't say that. When is Optimus going to be profitable? I don't know. But humanoid robots are the shiny new thing, guys. AI is already losing its luster. What EVs, that bubble burst. Autonomous self-driving cars are like crashing into shit. Will Optimus be profitable? Probably not anytime soon. Is it going to be humanoid robots is going to be the next shiny new thing after the AI bubble burst? Or will it be quantum computing? I don't know. My money is on quantum computing, but Elon is very big on the whole Optimus thing. So if Elon likes it, maybe that's what Silicon Valley is going to adopt. But then again, Elon is persona non grata in Silicon Valley because he committed the ultimate cardinal sin in Silicon Valley and became a conservative. And so maybe it won't be Optimus. I don't know. But yeah, when will inflation be 2%? Freaking never. That's my guess. The only way inflation is going back to 2% is if the central banks stop with the easy money and the money printing. They stop with the low interest rates, the Zerpenber. And we have learned over the last few years that they will divert to money printing every freaking time. Look at how quickly they spun up the money printers in 2023 when the banks started failing. I mean, they didn't even make it a day. By Sunday night, after Silicon Valley Bank had failed, by Sunday night, the Bank Term Funding Program was created. I mean, they got together on the weekends in the middle of the night to spin that printer up. So, no, I don't think inflation is going back to 2%. I'd love to see it. But there it is. Oh, yeah. And thank you, Robert, again. And Pasta Man, right, exactly. Schrodinger's 2% inflation. Inflation in 2027 is both 2% and 4% until proven otherwise. All we have to do is say, don't worry, guys. We're going to hit our 2% target a year from now. And just keep saying that a year from now, a year from now, a year from now, because a year from now never gets here because now keeps moving forward. So we'll just keep moving the goalpost, keep claiming 2% inflation, keep acting like we give a shit that poor people can't afford to eat. We're like, oh, yeah, my colleagues and I were acutely aware of the pain the inflation is causing the average person. Really, we feel, gosh, just terrible about it. And we'll talk all about it while we're drinking our radioactive shrimp cocktails with Jackson Hole later this week. Oh boy. God, I can't stand central bankers. Thank you, Pasta Man. Appreciate the support for the channel, sir. Hey, Stacy Taylor. What's going on, Stacy? How you doing, Stacy from Financial Prepper? How are you and Chris doing? Haven't seen you guys in a while. Would like your take on OSK Oshkosh Corp that keeps getting military contracts. A buy at this point. All right, I can't talk specifics to Oshkosh because I don't follow that one, so I don't know the PE. I don't know the dividend. I can tell you in general, European defense contractors I would be bullish on here because the Europeans got rid of their debt breaks. They agreed we're going to spend all of this money because Trump and Zelensky didn't play nice in the White House. That was back in February. After that big blow up, they decided we can't bank on the United States to come to our defense. And so Europe needs to rebuild their own armies. Now, we have had a little bit of a move towards world peace in the last couple of days, the summit in Alaska, and then the meeting earlier this week in Washington, D.C. with Zelensky. Those went as well as could be expected. And we did see a little bit of a sell-off in those European defense names after that. That could be a dip worth buying. I don't own any of these names, and I'm not buying any of these names. That being said, do you really think world peace is about to break out? Do you think Vladimir Putin's going to be like, all right, I've abandoned my egomaniacal ambitions. I'll go back to playing nice at sandbox? Almost certainly not. President Trump could throw a fit at any moment and just throw this whole peace process, a monkey wrench into the whole peace process. Or the Ukrainians could just arbitrarily decide, you know what, we're not going to carve off a big chunk of our country and hand it to Russia. Would you be any different if the Russians wanted to take California? Maybe I didn't think that out. Hey, Russia, you want California? I'll give you $1 if you take it. Anyways, that being said, generally, I'd be bullish on European defense names here because I do think this is probably a new multi-year, multi-decade even transition of Europe being less reliant on the U.S. Although for the moment, it looks like most of that European defense spending is still going to American defense contractors who are selling weapons to the Ukrainians now, or I should say they're selling them to the Europeans. The Europeans are giving them to the Ukrainians. But in general, defense names are probably a pretty good bet here. Thank you, Stacy. It was nice to hear from you, and thank you for the super chat. Madison Hype says, loved your China video at Silver Symposium. Well, thank you so much. An update. Well, look, home prices in China continue to decline. Home sales continue to decline. They're still kicking the can down the road on the liquidations in Hong Kong court. Most of these big developments in China, all the developers, one by one, they've gone bankrupt. There's still a few of them are clinging to life. Like I think Vanka hasn't gone belly up yet and hasn't been liquidated. But Evergrande, they're dead. The company's basically been dissolved, but they haven't been liquidated yet. Evergrande's supposedly hundreds of billions of dollars in assets have not been sold to raise the cash to pay back their creditors. They're just sitting there empty. The same thing is going on with Country Garden, who at one point was even bigger than Evergrande. So there are hundreds of billions of dollars U.S. worth of these buildings and these assets that are just stuck in purgatory. None of them have been sold. So while the Chinese housing market continues to decline, the sales are going down, it's affecting consumer confidence because people don't feel wealthy when their home goes down in value. The wealth effect, I talked about that at the Silver Symposium. When that happens, they spend less money. All of that is playing out. And yet the real big hit to the Chinese housing market, the liquidation of those developer assets still hasn't happened, which means we still don't have price discovery. And the Chinese don't want this to happen. The Hong Kong judges, which are basically Chinese Communist Party puppets, they're dragging on these cases. They kick the can a month at a time, 6 months at a time, over and over again. They've done it several times already while the central government tries to figure out whatever stimulus package they're going to put in to try to stimulate demand. And then once that demand comes back, then they're going to be like, okay, now sell off the assets. But the demand hasn't come back yet. The stimulus has been largely ineffective, or at the very least, it's only had a minimal temporary impact on the market before it resumed lower. So no, that story's not over yet. It's still going on, but those mass liquidations, that's going to be the defining moment. Whenever that happens and all those buildings get sold, and they're going to sell for pennies on the dollar, that's when things get really bad in China. And honestly, I mean, here we are, it's 2025. We first started talking about this story in 2021, and we still haven't had price discovery. It's a totalitarian regime, so they could just keep this going on forever. And, for people holding Evergrande's debt and people holding Country Garden's debt, you may never get your money back. Pay attention. Anybody who owns ADRs, American Depository Receipts, in Chinese companies, the Chinese Communist Party could just take your stuff anytime and go ahead and sue in Chinese court and see what kind of recourse you have. So that's why my personal opinion, China is just uninvestable at all. Thank you, Madison. I appreciate the kind words and the support of the channel. And thank you, everybody, for having your coffee with the Melonheads this morning. Wow, we ran long today. Hey, don't forget that like button and that subscribe button on the way out for the algorithm. Thank you guys so much for the super chats, the support of the channel. Thank you as well, you magnanimous Melonheads on YouTube and Patreon. Thank you guys for supporting me. Links down below should you feel so inclined. Don't eat the radioactive shrimp. Hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream